Good morning, ladies and gentlemen. Unfortunately, I don't feel well today. I've got out of bed just to do this video, so I'll run through it as fast as I can. I don't really have much new to say from last week, so I'll keep it brief. Really, the yield curve keeps on doing funny things. The fives keep on being the area that keeps on getting bid, and the twos are the area that is the least bid. You can see this is a chart of twos. Really, we are stuck in this 369 to 426 area. And with the Fed hiking again, really CPI this week is going to be absolutely key. I find it very difficult to believe that the twos can do better while CPI is strong and the Fed has not given a very clear signal that it has reached terminal. Certainly, ECB has not given that signal. In fact, it's given the opposite signal. It said that it's on a journey and that we are not at the destination yet. It's just how fast or slowly we get to terminal, but the terminal is not here. So twos, I would have thought, have to trade back around CPI, around the 4 area, and then we see. You can see really that this area around 413 is key, and if we bust 413 we're going to 426, but I really don't see us going much higher than 426. I think we are stuck in a range even in twos. Fives are by far the most bid area, and really they too though have maintained the previous lows. They never close below the previous lows, so I would have thought that any kind of a hot CPI number takes them back to around this 352 area, but there again we start getting bid even though we have auctions. And 10s and 30s much the same, but you can see that really in 10s we cannot break through this 324 area, and 30s are the least bid of all. Really they are just going up and down in a very tight range. What the yield curve is saying, on the other hand, this is twos fives, is that the twos just can't do anything because of where Fed funds is. I really would not be surprised at some stage if we close this gap to 461, whatever it is, in twos fives. But the really interesting one is fives thirties, which has basically closed below the previous lows. That has to be a long-term signal of disinversion of the whole curve, because I just can't imagine that we're going to sit around here and not disinvert the whole curve eventually, and that has to be a signal of risk off at some stage. It just has to be. I just don't see why we would be so bid in fives. All it can mean to me is that the market is absolutely convinced that at some period over the next whatever, the Fed has to ease, and the only reason why it would ease would be because we enter a mild recession. So will it happen now? I doubt it very much. I think that we can easily start stopping people out that got too excited down here and go back up towards 20, 21, 20. But I think again, the pressure will be on the downside in 5s, 30s. So to me, any kind of a hot number on CPI, I'm looking to re-enter around these levels, around 20. We will see what happens, but I think the whole pressure will stay on the 530s. Any other part of the yield curve is, 10s, 30s. It, you know, it. What can you say? It's stuck, but I think any kind of retracement to 2022 is again another opportunity to sell. The German curve is a little bit stuck, just like the US curve, but really I think that in Schatz we will at some stage trade around this 276 to 268 area. I mean, the Schatz is basically stuck around 268, as I said months ago. And the 5 year is the best performer, the bobble there, but I think even that will trade around the 245 area, and that's probably a good area to get long of it. The 10 year, much like in the US, also stuck between, let's say, 222 and the 240s. That's the kind of area that you are looking to trade it. But the really interesting one to me is the cross against the two, because let's face it, the ECB has told you quite clearly that they are still in a tightening mode. This is the twos, and I think that any move up towards 150 or even, this like 145 is a very high risk reward sell back down to 96. This is the kind of area that I'm looking for it to trade around 96. And if we look at fives, this also is a high risk, a high reward sell back down to 90. It traded to 130. I just missed it by a few ticks. And if we see it again, I think this is the natural area that it goes to. Tens is already there, but what that tells me is that the tens are stuck in both Germany and the US and will move very little. And it's really the twos and the fives that will move more in Germany and the US, which makes sense because if they are not, if they're not at terminal rate, really it's got to be the twos or at least the fives that move more in Germany than in the US, and therefore any kind of move here to 140, I'm a seller of Schatz and a buyer of the 2 year, looking for it to trade down here to 97. If I think the differentials between Germany and US are going to come in, I can't really be bullish of DXY. And the fact that really it keeps on doing very little to the upside increases the odds that at some stage it breaks down and trades at least down to this 139 to 99.83 area, at least, and most probably down to this 98.80 area. That would be my favored direction. And if we look at Euro USD, the fact that we just can't bounce anywhere significantly off this 110.64 area tells me that at some stage, let's go up to 113, that kind of thing. It's going to take a while because you can see that these Bollinger Bands on the weeklies are expanding at a very slow rate. So it might take a whole month to get there, but it looks to me like it's the favored direction of travel simply because any kind of rally in the dollar is sold all the time. And again, as I said earlier, if the differentials are coming in, if the ECB is still on a journey, and the Fed, who knows, that the favored direction of travel still has to be to the upside. And certainly you buy any dip down to this kind of level, 108, 55, something like that. You buy any dip there and you look for higher prices. Gold to me looks like it has shot its bolt. It just can't close at all above 2045 or 2059. Or I have another point. To me, it's coming down, and that would make sense because if the dollar is going to be weakened and the bonds aren't really going to do very much, why are you going to be very long of gold? The only reason to be long of gold here is one of fear about the debt ceiling, and that's about it. Um, you know, if the debt ceiling is not passed, it'll be a lot higher. But I think that trying to bet on the debt ceiling not being passed is silly. I think what you can bet on that it's going to be very difficult to pass the debt ceiling and it'll go to a minute to midnight, but not that it won't be passed. Uh, so, can you buy a dip to 1959? Yes, you can. And you can look to trade it higher back to 2045. But I think buying it at 2045, hoping that the debt ceiling won't be passed, is very, very difficult to do. I'm just not enamored with gold at higher levels. I'd much rather buy a dip if it dips because that will give me a better risk reward. But if I don't have it for the debt ceiling, I'm not too bothered because I think the odds of them not passing the debt ceiling are very low, but the odds of them, stumbling into it are very high. So, you understand what I'm saying. I think buying it up here is not very clever. Buying it down here at 1959, I think, is a far better risk reward. I think DBC is beginning to get to interesting levels. It basically did some kind of a double bottom there, and I don't know if I can enlarge that for you. Let me try on a weekly, but it's slowly beginning to come down towards the 2175 area and the 2050 area, which is both a 50% retracement of the whole move up and the 100% of an ABC back down, a corrective wave back down. So to me, this is the area that if you want to buy DBC, I have some commodity exposure. This is the area that you want to be bidding between 2050 and 2175 and basically keep on averaging down kind of thing. I'd be very surprised if that is, if we ever go lower, I mean, ever, this year, if we go lower than that level, because let's face it, that would be lower than we've been throughout 2022. And that is unlikely, especially if we have a look at what oil is doing. And oil, without a doubt, is in a very nice downtrend. Next week, I would have thought if we see it around the 73.5 to 74 area, it'll come back down. And, I made good money last week being short of oil. Naturally, didn't buy it anywhere near these levels. I bought it back here. I have to switch to this oil chart because my trade station is broken. So, oil, we were talking. I think this kind of level between 61.96, well, call it 62 and 57 and three quarters, is going to be very, very difficult to break. And I think that any kind of a spike into there, which would coincide with that DBC level below 2175, I think is a very good risk reward buy and hold. And when you think about it, this is the kind of retracement that we all knew was going to happen at some stage. A 50% retracement of the whole move of oil, and really back to levels that we were trading throughout 2018, 2019, and the natural level for oil. And from there, we can go up back into the 80s and 90s, and who knows. But that would really be the kind of level that I wouldn't mind getting long for the longer term. Well, the Blue Angels have started turning up, which is interesting. Uh, I think they're turning up in a nominal way, but then S&Ps are a nominal contract. It's it's disappointing to me, because the yield curve is giving completely the other signal, a signal that the disinversion is going to lead to a recession. Now, would I rather bet on the yield curve than the Blue Angels? Yes. But this is going to limit any kind of downside to the S&Ps, simply because unless we have, I don't know what, the fact that these Blue Angels are turning up is going to act as a magnet towards this times 18 area, which is exactly where we closed on Friday. And that is why we just can't keep on going down. I don't know what to tell you. I'm disappointed by it, and I'm surprised by it. Um, well, not so surprised as because it's nominal, but at some stage, if we get recession, that is going to turn. And that is what the yield curve is saying. It might be early, but the yield curve is saying that the bond market is definitely expecting a recession. And that really explains why we had such a quiet week in the S&Ps, and all we did was basically round trips to 41.64. It's very difficult to see what is going to move the S&P significantly lower. And really, until we start busting, 40.60, it really, and closing below 40.60, this market is just going to be supported all the time. And at some stage, we've really got to fill this gap up to towards 42.26, and there's another gap up here towards 42.84. So, can I see it substantially lower in the next couple of weeks? I don't think so. And that's why I keep on doing option strategies, because I don't think anything else has a chance of working. It's certainly, being outright bearish of it when the let's have a look at NQ. I mean, how is this bearish? The 200-day move, 200 period moving average keeps on rising. The dips are shallow. And now I think if we take out this 13,312 area, we are in this kind of 13,600 gap fill area, and then we trade 13,717. So as long as the Nasdaq is bullish, I don't see how the S&P can be bearish, and there isn't really the only contract which is even slightly bearish is TF, is the Russell. But even the Russell isn't all that bearish. It can easily trade up to the 200 period moving average and this resistance is 182.82. This is the IWM naturally, but it's the same thing. We just sort of move the decimal point. So really, I think you can trade up here, and there probably it's a decent sell for another retest of the lows. But it just shows you that it's all in a range for the time being. And I think the bottom of the range in the S&Ps for the time being is what we saw last week around around the 40.68 area. This kind of level, 40.53, is going to be very, very difficult to break unless we get very bad news. I mean, CPI would have to be very, very high for us to break that 40.52 area. And we would need to start anticipating much stronger hikes from the Fed. I don't see that. I think it's far more likely that CPI is reasonably warm but not hot, and that basically we keep on going sideways for the next few weeks and possibly fill these gaps, as I said earlier. To me, it's also very unlikely that the S&P would decisively turn down without Europe. And Europe has really been in a very tight range for best part of a month, hasn't it? It basically keeps on trading technically perfectly, bouncing off the Bollinger Bands. And really the move that we had down was so mild, and now we are back up, that I really wouldn't be surprised to see a retest of this 43.83 area. Get everybody bullsed up here by taking out this 43.66 to 43.83 area. Everybody gets excited at 44.40, and then you can come down. But again, until all these stock markets get in sync, and certainly EEM is not in sync at all. This does not look bearish to me. This looks more like that it's going to break this 39.90 area and go back up towards the 41.80 area. Rather than that it's going to go straight down. I don't think that's going to happen, and therefore, if I can't see that all these stock markets are in sync, I don't see why the US should go down all by itself. I've updated all the levels. Really, the yield curve is beginning to show an expectation of recession. It's now in the 530s, and I don't think the twos can catch up at any stage soon because of where Fed funds are. But when the twos start catching up, that will be, the very close timing that the market is saying the recession is happening. So now I'm looking at twos, threes, twos, fives to see when those start turning. I don't, obviously it is something which is not going to be imminent, not something that's going to happen in the next few days, but that is what the bond market is saying about the stock market. It's never really been wrong before, and I have to believe it. I don't believe that we are going to go below 40.64 next week in XPX unless the CPI numbers are very bad, and I don't expect them to be very bad because oil really has done nothing but go down. So I really don't see why it should be hot. I can see why it should be warm, but I can't see why it should be hot. And certainly NDX shows a tendency to go up towards 13,717. So I think that that is more likely than not to buoy the S&Ps. And DXY, I guess I'm bearish for at least 139, and gold, I think it trades 1959, and there the risk reward is good. At 2045 to 2050, it really isn't a great risk reward. Thank you very much indeed, and tweet you on Monday. Hopefully I'll be feeling better.